Let's talk about trust, baby. Let's talk about you and me. No, we're going to talk about trusts. And today, hopefully, because this is such a dry topic, I can make this a little bit exciting and memorable and also relatable and realistic as well. That's my goal for this today. So before I move on, let's put a caveat to all of this. None of this is financial advice. Do not take this as financial advice. Simply use this information to say, oh, I wonder if this is true. And now go and use these facts to then vet that against the actual experts. So the actual people who can really advise you on trust, the best people is an accountant and your broker, because the benefits of trusts are all around borrowing capacities and also asset protection and reducing your taxes into the future. Now, caveat to all of this before I go into the depths of all of this. It is very, very important to know in Australia that unfortunately only accountants are licensed to set them up and give advice on this. The downside to this is your accountant is not a wealth builder. It's very important to understand the scope of everyone that you have on your team. An accountant is simply somebody there to help you reduce your taxes. Primarily, they are there though and they don't like to hear this, but they are primarily there as a compliance checker for the ATO. That's what they really care about. So they're always anxious about getting audits, right? So it's very important to know that in the accounting world, they are very 3D and they're very like, I must follow this process, and they don't typically look at the bigger picture typically, okay? So there are a lot of benefits for trust when it comes to borrowing. Now, in saying that, there is a lot of pros long-term for trust, and there are a lot of short-term, small, really annoying cons. Okay, so it's very important to know all of this. Now, as we go throughout today, I will be highlighting to you and painting some pictures and telling you stories to hopefully make it easier for you to understand, okay, because it is quite a dry topic. But it's so important to know, especially if you are somebody who is planning on being an active property investor and buying multiple properties. Like the average person who comes to me wants to come to me to build a passive income. Most people on average who come to me and say, Olivia, I want $200,000 of passive income to replace my income over the next 10 to 15 years. Most people in that category would then need somewhere between 5 to 10 properties. Fun fact for you. Now, if you are that person, then this is definitely something you need to know. And most people come to me wanting that as an outcome. However, if you are just a person who just wants 1 or 2 properties and that's probably it for the rest of your life, then this really is probably not for you, okay? Because it is a lot more sophisticated. However, I'm also going to articulate why I'm thinking those things, and if you are a certain person inside that fits some of these metrics or these persona types, okay? Now, also before I go on, additional context is traditionally trusts were created for the purpose of accounting and asset protection, okay? So, however, there are actually some long-term lending benefits. Now, also what you need to keep in mind as an active investor is that there might be terms and conditions or benefits that we have today that might not stick around forever. And as what I teach my clients, that just because something exists today doesn't mean it's going to be there tomorrow, all right? And I'm forever seeing the market change and conditions and rules and regulations change all the time. So we must be nimble. We must be what we call agile. Agile means being flexible around not having a fixed mindset and relying on something that, you might plan to be like, all right, I want trust for this benefit, right? Which might be something you could do today, but you might not be able to do that in 10 years from now. So you just need to be mindful of that as well, all right? All right, so let's talk about trust. What is trust? It's a different entity other than you. Trust, I'm going to go into just talk about high level, the most common trust. Again, non-financial advice, you need to speak to your accountant in terms of which one makes sense for you. The most common trust that is used for property investing, though, is what you call a discretionary trust. It's also known as a family trust. The next popular one would be a unit trust. What are the main differences? Family discretionary trust is quite flexible. A unit trust is not. So with discretionary trust, you can move money around. It's best for a property. You can split the profit. So for example, if you make $200,000 of passive income, you can decide, I'm going to send it today. I'm going to send it this financial year. I can send it to maybe my one of my children, and then my wife, and then me, right? Or the following year you can change it. And the cool thing is you need, again, ask your accountant how much they charge to change the beneficiary. And you can do that quite regularly. This is the reason why rich people or wealthy people actually, in fact, own a majority of their things inside companies and trusts, because you can manipulate and control what you can do in the future. It just gives you time to plan and manipulate shit on paper. Such as changing the beneficiary and then deciding, well, you know what, this year I don't want Olivia to pay any taxes, but maybe we're going to send it to the wife, or we're going to send it to the kid, or send it to the cousin or something, right? So that's a huge benefit, and one of the main reasons why it was traditionally set up. Okay, so you can also help reduce land tax as well. I'll get into that a little bit more as well. You also get a 50% discount on capital gains tax if you choose to sell real estate, and you can, again, distribute that across multiple beneficiaries, right? You can also, I mentioned this one, distribute profit across multiple people. If the government wants to come after you or come after the things in your personal name, I shouldn't say they can't. I should say it's harder. It just creates more barriers. So I once interviewed another woo-woo accountant who used to be, he used to work for the bad man, aka the ATO, who worked for years, and he used to be the person that if you don't pay your taxes, he would come after you, right? And now he realizes, he's like, oh fuck, I can't believe I worked for the ATO. What a horrible human I was, coming after people's assets. So he's now on the other side. Anyway, and I interviewed him, and he said, as soon as people own shit inside trusts, he said it would just become, there's so many extra layers of barriers that if they were trying to come after you for $100,000, they're like, it's not worth it. We'll just fucking wipe it. And I was like, wow. Now, again, that doesn't mean your shit's going to be wiped, doesn't mean you could be dodgy, etc. But it just creates that extra layer of protection. Doesn't mean it's a hard protection, apparently. Okay? And you could also pass on roles inside trusts. And you can also decide who's going to be the power of attorney of a trust as well. Okay, let's get into the actual juicy stuff of trust, what you're all here for. These are the pros and these are the cons. These are the things I've been collecting over the last 5 years of my knowledge from a bunch of brokers, a bunch of accountants, a bunch of buyer's agents, and me personally working with over 270 to nearly 300 clients now, I think. So over the last couple of years. So I'm very, very, very experienced in understanding trust and who it might be for. So, first of all, the biggest and the number one pro that we like for active property investors, meaning people who are going to consistently try and build a property portfolio and get past more than 2 or 3 properties, is to protect your borrowing capacity. How it does this is by any debt that you take out inside a trust, it can be ignored. True fact. So the terminology that they use in, especially brokers that use it, this analogy, they actually explain it by saying they silo away the debt. Meaning, I'll give you an example. Say, for example, you can borrow $600,000. Now, if you go and buy a property inside your personal name, right? So not in a trust, in your personal name, you used up, let's just say for scenario's sake, you used up the full entire $600,000 and you bought an investment property. The rent from that tenant would do a lot of the heavy lifting, probably protect your borrowing capacity by maybe 70%. Now, let's just say you used up that $600,000. You then went to the bank a month later and said, hey, bank, here's the rental income statement. Now what can I borrow? Well, they'll turn around and say, potentially, that will now, let's just say the interest rates have stayed the same. So they haven't gone up, haven't gone down. Then your borrowing capacity would likely drop from, say, $600,000 to potentially $400,000, right? And now that $400,000 might not be enough to buy another property. But guess what? If you bought the property inside a trust instead, and you use the same $600,000, then the bank will say, well, the broker can then do is ignore and not tell the bank that you even got that $600,000 to begin with. Or you can tell the bank, but as long as the bank has like an accountant letter to say that trust is looking for profitable, it's fine. They won't really consider that as your personal debt because it's not in your name. Because a trust is not you. A trust is a different entity, even though you are the owner of that trust and you're responsible for that debt. So essentially what I'm saying is that borrowing money inside a trust can be an infinite way of consistently borrowing money and borrowing money and borrowing money. Now, there are a lot of downsides to this. Number one, what did I originally tell you? This has been around for the last 40 years. I personally am not going to pretend as if this is going to stay around forever. Because again, what did I say is that this was originally designed from an accounting perspective, was trust. Was it designed for tax deductions and risk mitigation, all of this sort of stuff. It wasn't designed for this benefit of ignoring your debt. Personally, I've got a gut feeling, and I'm not sure about it, but the bank at any moment, because people are starting to use trust a lot more now, because again, with education, it's easier to get information online, and people are stuck with borrowing capacities recently because of interest rates have gone high, et cetera, et cetera. So trust all of a sudden have like blown out of the water, and everyone's talking about it online, and everyone's like, yeah, fucking trust. Now, you've got to also remember that this might not be around forever. Just because it's been around for the last 40 years, I wouldn't rely on this, again, as if it is going to stick around, okay? So when I'm talking to clients and I'm thinking about the importance of their borrowing capacity, I'm thinking to myself, 2 or 3 steps ahead, 2 or 3 properties ahead. I'm thinking to myself, okay, does it seem like they're going to end up buying a couple more properties? Like they're going to keep building a property portfolio? Yep. Okay, great. And are they showing that they're hungry to build a property portfolio and keep moving forward? If it's, say, for example, a single mum who's coming to me and all they need is just 1 or 2 more properties and that's it, maybe this isn't the thing for them. So how I like to think of this is how much wiggle room of borrowing capacity does the person I have in front of me have? So, for example, what I would like to see is that they have at least an additional $200,000 of borrowing capacity on top of whatever the average is of real estate, or like a pretty reasonable property that we can buy inside the top 1% suburbs for growth. So, for example, as I'm filming this in the middle of 2024, let's just say my team can buy really elite properties with no problems inside the top 1% suburbs, and we have capital growth guarantees as well. Let's just say we can buy them for, say, $550,000. So let's say, as a benchmark, I would say to my investors, we've got to make sure that we also have a borrowing capacity of at least $200,000 on top of whatever the averages are. So if I can buy them for $550,000, I want to see at least that person's got at least $750,000 in terms of borrowing capacity, because then they have a bit of wriggle room for it to drop, right? So if your borrowing capacity was less than $750,000 at the moment, I'd be telling my clients you really need to consider this trust for the purpose of your borrowing capacity, all right? Whereas if you have borrowing capacity of, let's just say, $1 million, you probably have more than enough wriggle room to buy at least 1 more investment property inside your personal name. So this is the biggest instant upside to trusts. This is also hugely beneficial if you are somebody who is considering upgrading your PPR, so your home, one day or in the near future, or somebody who will need to buy a PPR one day. Like you might not even have it yet, and you might be a rent investor like me, okay? So something else to consider there. Now, the other huge upside for trusts is it can really reduce your land tax only in the states of WA and Queensland. So ironically, at the moment, where a majority of the top 1% suburbs are at the moment in 2024 and have been for the last few years is WA and Queensland, okay? And the reason being is because the land tax of when it starts has what we call a threshold. So it won't start charging you land tax until the land on its own, not the whole value of the property, but the land on its own is worth at least $350,000 instead of $0 in other states. Now, the opposite is true if you're going to buy, which I'll talk to you later. The land tax is actually higher for trust when buying inside Victoria and New South Wales. So I'll come back to that in a minute because that's a real downside. So like buying properties inside trust in New South Wales is like pretty dire. So you really need to consider that as well. So for me with land tax is one of those really nasty bills which I personally like to delay for as long as possible. And how I do that is by buying in multiple states and buying in multiple entities. So for example, let's just say I'm going to buy 3 properties in WA. What I would do is to not trigger land tax at all, is I would buy my first 3 properties in WA under all 3 different entities. And then what I'm doing is I'm really triggering. So let's just say I buy house number 1 in one trust, house number 2 in another trust, house number 3 in another trust. And house number 4, I'll then go back and add that into trust number 1. So now I have 2 trusts in that one. Make sense? So then you're really delaying when land tax will start triggering for you. And the purpose of this is because when you're starting out to build a property portfolio, these small little costs, which I'm about to go into on the con side in a minute, they can really start to add up, and that can be the thing that stops you from buying property and buying assets, because we want to be able to have as much cash flow in our pocket to begin with, because the first 5 years is always the hardest. The first financial year of owning a property is the hardest, and it just gets easier and easier and easier as each year passes. So we need to have a way of reducing expenses, okay? And this is a really great way. So for me, I really like buying properties in WA and Queensland inside trusts for this benefit as well. Now, to one of my favorite ones. These next 2 ones is quite critical. These next 2 benefits are something that I personally am looking towards. So these benefits that I'm looking at, these 2 benefits here are really long-term things. These are things that is probably going to take, it's like a 15 to 20 year strategy. Okay, so let's talk about them. Now, and also these things I'm letting you know, these are everything that I'm talking about on this video today is extremely rare, just to let you know, and it's not very well known. Just to let you know, I've spoken to many accountants and many brokers, and not even accountants and brokers know this sort of stuff. But again, you're speaking to Olivia, a coach who's all about hacking the system and finding out as many. Refer to myself as a little hacker. I'm like the leverage queen that's a little hacker, right? And so I'm always trying to look out for tiny little hacks, and I piece the puzzle together. So I did a brokering course once. So I'm not a licensed broker, but I did do a brokering course. And one of the things I learned is that once you own at least 4 or more properties, residential properties, inside a trust, there are then some lenders who will allow you to take the loans up to 100% LVR. And if you are anyone who understands inflation, like my clients, and I'm training them to understand how debt is irrelevant with inflation, I'm extremely bullish with real estate, and I want to obtain as much debt as possible because I understand the Ponzi scheme of inflation, and inflation is really 12%. It's just chewing that away. What does that mean? That means I want to go and take my loans up to as much debt as possible. And so I want to basically put down 100% deposits, or 120% if I really could, right? And so the cool bonus is with owning properties inside trust, if it's at least 4 residential properties inside one trust, then you could potentially use some lenders who will allow you to put 0 deposit down. How fucking cool. Or leave 0 equity inside a property when trying to loan money. And for me, this is epic for me. I fucking love this shit because I love leverage, right? So the other one is that you can actually lend on the gross amount versus the net. Again, if you own 4 properties inside a trust, what the fuck does that mean? So I'll give you an example. Okay, so on the gross versus net, say for example, so you own 4 properties inside one trust. Let's just say they're bringing in a total, and I'm being very average here with average numbers. Let's just say they're bringing in $30,000 of rental income each. So if I do $30,000 times 4 properties equals gross $120,000 of income per year. Now, if you have 4 properties inside a trust, with how high interest rates are in the middle of 2024, usually about your borrowing capacity is usually 5 times your income roughly now. 5 to kind of 6 is a big stretch. So I'm using 5 to be conservative. So if I go 120K times by 5, that essentially means you could potentially borrow $600,000 of borrowing capacity with that trust without you having a 9-to-5 job. How fucking cool is that? So again, this is something that I'm looking for and that I'm building towards for future me. How can I borrow money without me having to go have a 9-to-5 income? How can I keep borrowing money after I've retired, as an example? So, but whereas in the normal way, if you didn't have this option, if you went, again, $30,000 of income times 4 properties, the gross would be $120K again per year. But then if they were owned inside your personal name, then we would have to include the debt, the mortgage repayments. So let's just say, not just mortgage repayments, as an example, it would actually be all cost. But let's just say, for example, it's $100,000 for the year in terms of mortgage repayments and other costs associated. So then your net, so your rental income minus your expenses would then really be, say, for example, $20,000 per year. If I use the same rule here times 5, $20,000 of income net times 5 will then only give you $100,000 of borrowing capacity. What would you be able to borrow? $600,000 or $100,000? We'll do the $600,000. So this is just another option and another benefit. Again, this is something you have to build up towards to even be able to do this. Again, your trust would need to look profitable on paper, which generally is in the first 5 years. And again, you'd need at least a minimum of 4 residential properties or 1 commercial property to be able to do this. The reason why it needs to be 4 residential properties is because then some banks then look at it as a business. And this is how business loans work, actually. So there's a lot of business loans out there. You can borrow money based on your gross before all of the expenses. So it's essentially treated like a business. That's why. Okay, and now there's some other small benefits. I'm not going to spend much time on it. Some additional things, because these are really small benefits. But the buyer's agents, if you want to use the buyer's agents, it's seen as a business expense, so it's claimable inside a trust. Again, there's another video I have. If you are going to do this, it's very important to understand how to make a trust look profitable on paper, which is most accountants' issues that they have with this. So if you want to know how to make a trust look profitable on paper, please let me know. Reach out to me and I can send you a specific video on that, because that is critical as well, especially in the first 5 years of you building wealth. And then obviously there's loads of safety features and security things, which is stuff I spoke about before in passing on generational wealth. And there is a tiny little hack as well, which again, only some accountants know how to do, but you can have the beneficiary as, for example, your super company and pay 0 in taxes inside your super once you get older, once you reach your preservation age specifically, okay? And you can also do things, this is getting really advanced, but you can also have the beneficiary change to bucket companies, which is again something where you can delay taxes for like 6 years and all that sort of stuff. So this is like really for like ultra wealthy sort of people. But again, it's cool to know and cool to be empowered with this information as you're starting out. Okay, let's talk about the cons. These are very important to know. So the biggest con, which most people choose to, which I don't believe that you should, which most people choose against for, and so do accountants, is that you get no tax deductions off your 9 to 5 income. So this is another area where I'm talking to clients and I'm looking at them thinking, okay, do they need tax deductions off their 9 to 5 income? I might have, for example, high corporate employees, high income earners in the corporate industry, where they're on, let's just say $200,000-$300,000 a year, and they're paying fucking 50% taxes, and they're giving away $80,000 a year in taxes, right? As employees, you don't really have the option to control your taxes like business owners do. So if you were an employee and your borrowing capacity was, above $1 million, I'd be highly considering getting some tax deductions from your 9 to 5 job if you have no other way to do that. The other thing I wanted to mention, and the only reason why I say that is because with business owners, typically business owners can really control their taxes. And if you're a business owner and you're not controlling your taxes and you think that you're stuck in terms of what you can claim, you definitely need to be spending a lot of time. Non-business coaching advice, although I am a business owner personally. So if you are a business owner watching this, I have personally as a business owner, I have worked out how to pay no taxes legally 2 years in a row and still have borrowing capacity to keep moving forward. And it's a fine art, and it's something I've been working on for years, but it is possible. So if you're a business owner out there paying too much in taxes, feel free to reach out to me if you want some additional videos that I can send you on how to do that. But in a nutshell, most business owners know how to reduce their taxes. In fact, business owners typically do that too well, to the point where they have no borrowing capacity. Anyway, that's another topic for another day. So it's very, very critical to understand you'll get no tax deductions off your 9 to 5 job. Now, to let you know this, I'm going to give you an example. This is not factual information. So let's just say, for example, you have a property you've bought and it could potentially be, give you, say, $6,000 in terms of a tax return at the end of the year through depreciation. Now, that $6,000 might literally be the deal or no deal, or the thing that breaks you, or the thing that allows you to hold on to property through different storms when you start. So when I have clients who come to me who are really, really financially sort of tight, I actually highly consider them, especially if they don't have a consistent savings rate and they're not able to withstand any negative cash flow. This is something, again, that I talk to clients on a deep level, because that additional $6,000 could be the difference of them holding on to the next property or not, which could be the thing that makes them, in the long term, an additional $100,000 or $200,000 or $300,000 of capital growth in the next couple of years. And so maybe that $6,000 is exactly what they need. So, but is that $6,000 worth you risking running out of borrowing capacity? Because the second you don't have borrowing capacity, well, you're fucked. Your wealth is on pause. Because 60% of the game of real estate, honestly, is what I call a game of finance, or a game of banking. And what this means is tricking the bank to consistently give you money. And this is just one of those things. So again, if you're tight on borrowing capacity, and if you really do want to see your keep buying properties, but you don't foresee your income going up, then this is potentially something. This then could be the thing that's more important than this, than getting that $6,000 in terms of tax deductions. Also, something else to consider is your lifestyle, for example, right? I might have a young person come to me, they're in their mid-20s, and the borrowing capacity is like, let's just say $600,000. But that person, because they're in their 20s, typically you have 10 to 20 years of extreme career growth, meaning you're typically in the lowest income earning bracket, and it is likely that your income will naturally go up through your career. So potentially that is also something we need to consider as well. Is your income going to go up? Is it really just bad just right now? Are interest rates likely to go up in the short term as well? Are you buying property right now during a storm where interest rates are high? So therefore it is likely your borrowing capacity would go up when interest rates come down, and vice versa. Are you buying inside a window where interest rates are an all-time low, and could they potentially go up? So you also need to consider that as well. All right. Now, let's talk about the nitty-gritties, which most people don't talk about online, especially accountants. They don't even like to refer to this. So, costs. Now, again, no financial advice, go get a quote from your accountant. So, a typical off-the-shelf trust, most accountants would charge somewhere between $1,500 to about $2,500. I've put about $2K here to design and buy the trust once off. Then, the next cost is you then need to have a legal advice, a lawyer witnessing you signing your mortgage documents, which again typically are found between about $1,000 to $2,000. So I've put $1,500 here. This is for every time you buy a property inside a trust, for each time you buy the property. This is more formally referred to as getting legal advice as a guarantor, because you as the person are going to be a guarantor for this trust that you're setting up. The reason why you need to get this legal person is because it is a lot harder, again, for banks to come after you if you choose to default on your mortgages or not pay or whatever. So for them, there's a lot more risk involved with the lenders. So they're like, well, we need to make sure that you understand as the guarantor that you're still responsible for this debt. So don't try and run away, all right, and not pay for it. That's the reason why you've got to get this legal advice. Now, then there is an ongoing accounting fee just to have that trust done for every single trust. Again, get a quote from your accountant. For most accountants, I see somewhere between about the $1,200 mark to $2,500. Again, depending on the complexity of your trust. If you're making it with all these bolt-ons and add-ons and extra features, the more of that sort of shit you add on, the more expensive it's going to be. So again, get a quote from your accountant. How much are they going to charge you ongoing to do the tax return? And you need to have this included, this as an ongoing fee each year. okay? Now, the same as to what I was mentioning up here, this is something brand new. The next thing, again, this didn't happen a couple of years ago. So banks are now, because of all of these people coming out starting to use trust, they're like, fuck, we got to have more due diligence put in. So if you happen to refinance and move from one lender to another lender with a trust, again, they can force you to go and get the legal advice, the same as what you did up here to buy the property. Now lenders are starting to come out. Some lenders are starting to come out and say, you need to get a legal advice again, even just to refinance and move from one lender to another. Now, as a coach and an active investor, it is very likely that as being an active investor, you need to consistently refinance and move mortgages. I'd say on average, somewhere between every 3 to 5 years, you have to move lenders as part of your strategy. Right? And typically you're moving lenders for getting better interest rates or getting better terms and conditions. So this didn't used to be a fee that we had to think of, but now we do. Imagine refinancing and moving lenders every 3 years and recopying this fee again. All right, so again, something else you need to think of. This is something new that's just come out recently that I've started seeing a trend. Okay, then we've got the ongoing ATO fee. This is currently in 2024 about $320. Again, don't quote me on this. But the ATO keeps popping this number up. I believe in 2023 it was only like $270. It just keeps going up. So that's something else to consider as well. Again, you need to put that inside your tracker of your expenses. All right. So with my team, we have a full-on nerdy ass spreadsheet to track everything for you to see your actual net that you'll walk away with. Something else to consider of is there is a lot more paperwork. It's a bit more complex, right? However, if you add up all of these, sometimes these pros still outperform all of these downsides. To me, these downsides are really small if I added them all together. Now, in saying that, they would be more of a downside if the properties were cheaper and your net rental income wasn't that high. So it might make more sense to cop these fees for a property that's, say, for example, worth $1 million that's getting you $1,000 a week in rent, as opposed to a property that's $400,000 only getting you $400 a week in rent, right? Then this can start to chew away at it as well. So it's all about the performance and the cost of that property as well. So the net income of that property. Now, sometimes there are slightly higher interest rates with trust. Sometimes about half a percent to 1%. Again, something else you need to consider. Sometimes they are for some people, not always, right? It depends on you personally as well. So sometimes the interest rate can be exactly the same. So again, something else you need to confirm with your broker and say, hey, broker, is my interest rate going to be higher if I put it inside a trust? Does my borrowing capacity drop if I put it inside a trust? For some people, it does impact them. From my observation, I'd probably say about 50%. So from what I've seen of people that come my way. Okay, so as what I mentioned before, if you're buying a property inside trust, the land tax is actually higher if it's inside Victoria and New South Wales. The reason being is because, unlike WA and Queensland, instead of the land tax starting at only $350K, land tax for Victoria and New South Wales starts at 0. So the second you own real estate, it's 0%. In South Australia, I think it's 25 or 30K, which is basically 0. Like, what land are you going to buy that's under $20,000 or 25K in South Australia? Even though property over there is cheap. So again, you need to reassess. If you're going to buy a property, especially in New South Wales and Victoria, I'd really highly consider buying properties inside your personal name then. But again, what is the objection and what are you actually trying to mitigate into the future? So with trust, now with some people, some professions, such as doctors, lawyers, real government, would help if I got some spelling right. So a lot of professionalized professions out there can get free LMI, free lender's mortgage insurance. So LMI, getting free LMI is fucking incredible. I, as somebody who is, again, extremely bullish with real estate, I've paid LMI like 9 times and I'll continue to do so because it allows me to put in less money. I've got a separate video on that. If you want that, let me know. So Some professions get free LMI, which could be literally thousands and thousands of dollars. So if like you're buying an average property of say $500,000 and you're putting in an 88% LVR, your LMI bill normally might be say $9,000. But some of these professions get free LMI just purely because of their jobs. Now, with some lenders, with some trusts, don't get free LMI either. So if you are have one of these professions, there's a bunch of them, there's more than this, that would get free LMI in your personal names, and you're considering a trust, you really need to ask and just triple check with your broker, will I get free LMI if I buy this property inside a trust? I'll give you an example. I have a client right now who in her personal name, she's a nurse, and she will get free LMI if she buys properties inside a trust. But she'll get free LMI if she bought inside a personal name, but not if she bought inside a trust. Whereas I have another client who works for a bank directly. The bank will give them free LMI in their personal name or even if it's in a trust. But that's because they're a direct employee of that specific bank, which I believe is Westpac. So that's also extremely important to know as well, because LMI can really add up. It's literally thousands and thousands of dollars. Imagine if you buy multiple properties. Something to consider. Now, something else I actually just thought of and I forgot to pop in here. Some lenders have no offsets for trusts. Some. So again, something you need to confirm with your broker. If you are somebody who has a large amount of cash and you are planning on offsetting your property, again, or you are wanting to move equity from properties inside your personal names to stitch it against the offset in your trust so that you can make the trust look profitable on paper, again, you might not be able to offset it. So you need to triple check with your broker. Hey broker, if I buy this property inside a trust, will this particular lender give me an offset? Because if offsetting your trust is part of your strategy to make your property look more cash flow positive, etc., or you're someone who has a large amount of cash, let's just say I have some clients who are single mums who have just gone through a divorce. They have a large lump sum of money, but they're cash flow poor and they don't have a lot of cash savings to be able to keep any negative cash flow properties afloat. So they just can't put anything else in it. So therefore we're relying on a large lump sum of cash to be sitting in their offset to reduce the repayments and make the property positively geared or net neutral on paper. If you don't have an offset, well, that fucking throws out that whole entire strategy. So make sure you triple check that as well. And now the last two things, I'm not going to spend too much time on these ones. Some properties can be, technically it's called cross-collateralization. Cross-collateralization is basically where you have everything in one bucket and they are dependent on each other or they can go after each other. I'll give you an example. Say you own 4 properties inside of one trust. And say, for example, I'm going to give you a worst case scenario and a complete horror story, which is very, very unlikely to happen. But let's just say one of those properties, you forgot to pay your building insurance or your insurance altogether that year. Now, this has happened to one of my mentors, by the way, who owns 270 properties, and he was having his property managers pay his bills. And this is where I say sometimes it just doesn't make sense to own this bloody goddamn many properties. So he forgot to pay, or his property managers forgot to pay his insurance one year. That one house just happened to be burnt down. And the tenant's car ended up getting burnt away with the house, right? So then what happened is that tenant then tried to start going after and suing that person for the other properties inside that trust. But they can't go after them for anything else outside of that trust. So this is where, when people ask me, Liv, how many properties do I want to own inside a trust? Well, that's a very good question. If you're going after these long-term things, then you probably want 4. If you want these benefits, so the LVR benefits, so being able to borrow up to 100% LVR and being able to lend based on the gross amount, not the net, that's what I'm aiming for. So for me, I personally like 4. However, you also might not just want to have one property per trust. Because why? Because then the expenses really start to add up. And then you're probably not going to walk away with much net to actually live off it at the end of the year, at the end of your life. But then the opposite is true, is like you probably don't want to have, say, 10 or 20 properties inside one trust. Again, why? Because they're all under one umbrella, and then they could all be going, like, you could get sued for everything under that one umbrella. So you're not diversifying your risk portfolio, which is a reason why trusts were originally designed for many, many years ago. So it's something else to consider as well. So it's not ideal to have heaps of, and again, this is going to come down to your own personal risk strategy and your risk tolerance as well, right? So for example, I have some doctors, some surgeons who are literally, they've got people's life laying on the fucking bed that they could kill someone tomorrow, right? And that person, could they go after their asset base, right? So again, some of those surgeons, right, want huge diversification. Again, I have police officers who could go and murder someone tomorrow and shoot someone. Again, someone could go after their asset base. So these things are things that you need to highly consider, all right? Now, the other downside is that typically buying inside a trust is typically negative on paper for the first year to 2 years, which is very normal. Why? Because that's when the most amount of expenses are occurred, or in the first year or 2 years of you owning that property, and you're waiting for the rents to go up, right? But again, if you watch my other video on how to make a trust look profitable on paper, I've got a separate one on that and how to do that. I highly recommend it, because there are ways that we can basically, within legal reasons, manipulate and make that trust look profitable on paper. Worst case scenario, we can always ask for an accountant's letter when it comes to brokering time, and we want to ignore the debt, what I was originally telling you up here. In order to ignore the debt, it needs to look neutral, or we need to have an accountant say, yep, this trust is profitable, all good, send it to your broker. Most accountants do that. So, in a nutshell, trusts are really good for those who are aiming to build a property portfolio for passive income. So building a positive cash flowing property portfolio. This is not ideal if your strategy is around negative gearing. Then it's dumb, because you're just not going to get the negative gearing benefits. Okay, so that was a lot of information, and maybe you're feeling a little bit overwhelmed with like, fuck, what's the right answer? If you have a strategy call booked in with me, this is something we'll go into in detail as to whether or not this makes sense for you, and I'll articulate it for you so that we can then draw up certain questions so that you can then use that to go to your experts, such as your brokers and your accountants, to then confirm the upsides and the downsides to you personally, and so that you can get professional advice. Oh, and one last thing I typically get asked as well is, can you move an existing property you already own in your personal name to a trust? Yes, you physically can. Most of the times it does not make sense to do it for majority of people. The reason why is because the government will recharge you stamp duty, and they'll charge you stamp duty at whatever the value of that property now is. And they'll also charge you capital gains tax for selling it if there's been a capital gain. So for most people, it doesn't make sense. Sometimes there are really high net worth clients where it does make sense for them to do that. Extremely rare. So it's just something to think about. This is the reason why it's really important to make sure that you're setting up the properties in the right entity to begin with straight away. All right.